Hello and welcome to the Matt Chambers Show, connecting people, places, and ideas. I'm your host, Matt Chambers. This is the podcast about living, traveling, and doing business internationally. Each week, we bring you inspiring stories and actionable insights to help you create a life beyond borders. Tune in and turn your dreams into reality.
Things are fine. Things are fine.
Good,
I
good.
won my
Yeah,
squash game this morning, so that's a good way to start the week.
you won your squash game?
Yeah,
I got it. That's your hobby of choice, huh?
yeah.
Yeah, that's a tough one. That's a heck of a lot of cardio.
It is. I play a guy who's 17 years younger than me.
Oh wow, yeah. So if you won, I would call that a win,
Yeah,
right? God, it's a double win.
yeah, exactly.
Yeah, I know. A lot of the stuff that I do now. I'm 40 now, which I guess is still considered young to a lot of people, but it's not so young when you get in there playing against 20, 25-year-olds.
Yeah, it does make a difference when it comes to athletics.
Absolutely. So, yeah, we can get started. If you want, just why don't you share a little bit of your background? And I know you're a CPA and kind of what got you into that, and then with a big focus on the real estate industry, right?
That's correct.
Yeah, why don't you share a little bit about how you got there and a little bit about what you got going on now.
Okay, so my name's Michael Matthew. I'm located in Toronto, Canada, and I started focusing on real estate as of just about 15 years ago now, when I went to these conferences in the US that dealt with investors from Canada and the US, and also had a strong business component to it. And after going to a few of them, I started to wonder, how can I fit in to this whole industry best? And I realized that one of the big weaknesses of many of my fellow investors was dealing with their taxes, with their accounting, with their setting up of their structures, and dealing with the tax authorities in both countries. It's something that I do all the time. And so that's what I decided to focus on as my niche. In addition to being an investor myself, was to deal with the things that they don't like to spend their time on, are horrible at doing, or just don't do at all. And that's even worse. I think my first big real estate client had 9 tax returns, so 3 companies times 3 tax years not filed.
Oh,
The first step was digging out of that hole, and to this day it was one of my most memorable experiences, because despite having a CPA and a bookkeeper in place, I couldn't believe the books. They literally booked swimming lessons for the kids in the company's books.
oh,
I said, what is this doing here? Well, we just want to keep track. If you want to keep track, you can absolutely do that. You open up a new QuickBooks file. It's called
personal.
My Family, and I never look at it. You
Yeah.
don't have it in your company's books. And
Oh,
after spending a solid week, I mean 40 hours, trying to deal with it, I decided, okay, here's what we're going to do. I'm going to pull out the figures I think I can work with, start a new file. We will have no history of what went on before. And we're going to pray the tax authorities never ask to see it, because it's a royal mess. And I'm just doing the math. I believe the statute of limitations has now gone past where they never can. But that was quite an eye opener. And it just goes back to ignorance more than anything else. And uh, the client knew enough to know not to keep her own books. And she knew she had to hire someone. But how do you know if you know nothing about it, which is why you're hiring someone? How do you know if they know what they're doing? And obviously they didn't, and she didn't. So it was just a big mess.
well, I think one of the things that 99% of people don't understand is that just because it says CPA beside of someone's name, that doesn't mean they're all on the same level, right? There's different levels to the CPA thing. And I think as a businessman, you can outgrow them, right? As you grow. And I've met a lot of people over the years, and including myself until the last few years, um, and that don't realize that after not every CPA has the same knowledge, right? And the continuing education, I think, is also important, right? A lot of CPAs seems to me like they get their license, and then some of them just kind of say, oh, "Okay, I'm a CPA now. I know what I'm doing." But the ones that are good continue to educate themselves on the tax law, and that's a lifetime journey, right? I mean, that tax code's huge.
It is, and I spend thousands of dollars every year on that exact thing. And the major reason why is they keep changing the tax code every year. So
Yeah.
you could have, even if you memorized the tax code when you started, 5 years later, it could be unrecognizable, right? Because they've changed.
Can you even memorize all
Oh,
that? Isn't the U.S. tax code like 66,000 pages?
you wouldn't want to.
I was gonna say, I think I looked at it one time. It's like 66,000 pages.
Yeah, I know that it's a good cure for insomnia.
For sure.
One,
Yeah, I think the only people that like doing taxes are accountants, right? Like,
yeah, it's not something you really should get too deep in yourself because your job as a business person is to build your business, not to learn the
mhm,
tax code. So you need to know the basics. You need to know how to keep good records. You need to know to keep them organized, and you need to file your tax forms on time
mhm.
and keep the tax men at bay as much as you can. And when you don't, you have what I have now, which is a payroll audit because they hadn't filed in a while, and the government comes calling and we've missed you, or more accurately, we missed your money.
Exactly.
So we're going to see what we can do. And it's something that I look at as providing peace of mind by handing it over to a professional. And as you pointed out, not all professionals are created equal. A professional who specializes in your type of business, I think, is the best way to approach it because I don't know everything, but I do know certain things because it's come up. And while you start off with similar educations as to the other CPAs, your actual work experience is completely unique to you. And
Mhm.
I have come across things that CPAs 15 years my senior didn't know the answer to. Not because I'm smarter than they are, it's just because it's literally come up for me. It never
Mhm.
came up for them.
Well, the answers that you don't have, someone in your circle likely has there, right? Is
Some in my circle, and also knowing, frankly, how to take advantage of AI and
yeah.
use it intelligently. And it can be very helpful if you know how to use it. It can also be very damaging if you don't. There was in the news about 6 months ago, I think, a lawyer came into court with all these citations supporting his position. Only little hiccup in the whole thing was none of them were real. ChatGPT hallucinated every case. And
Mm.
when it came out, the judge was not very happy. Let's just say that the guy wasted the court's time with these made up cases.
Oof. And so what kind of real estate are you investing in now? Are you just doing personal stuff or syndications with other investors or?
Right now, it's just personal stuff on the one side, but I also have a different branch with a partner that does more of the larger deal syndications. And
So multifamily and then multiple investors invested in single family, stuff like that. You guys can write contracts and all that for.
right, and I work with allied professionals. As I said, I'm based in Toronto, but I work with American CPAs out of Texas, and they work with real estate investors from every state, and we're able
Okay.
to set up corporations as needed and file all the returns.
What I know you mentioned on your website that someone new to real estate investing should take some specific steps to minimize risks. Where were you headed with that? What's your advice on that?
You need to get some education, and that can be from a CPA like myself. There are many courses, of course, and you need to get a coach or a mentor, which I offer as well, and then you need to take action. Minimum-
You're offering a real estate mentorship, or you're offering tax advice uh,
It's
for real estate
real estate
investors.
mentorship as I do it, which has a strong focus, of course, on the taxes, but it's that's not all of it. In fact, my book, which is A to Zen Real Estate Peace of Mind Strategies for the Canadian Investor, focuses on more of a holistic approach to investing because while I recognize tax knowledge is a weakness of many real estate investors, if you know that and you don't know anything else, you're not going to be able to take action. You need to know where to invest, how to invest, what to invest in, how to set yourself up, the importance of having a positive mindset, and all that is covered in the book. So it's meant to be a comprehensive introduction to the whole industry of real estate investing.
So you're advising people on where to invest as well in the book. You mean when you say where you? I assume you mean what states, what asset classes. I mean, what areas of real estate? I guess what segments.
Some of that, I mean, the very first thing to start off with where to invest is it a landlord friendly jurisdiction? Because if it's not, you can end up like New York and California where someone can actually squat on your place and
Mm-hmm.
you have to evict them just as if they're a tenant. You can't just throw them
Mm-hmm.
out. And even if you have a tenant with a lease, if they choose not to pay, it can take over a year to get them out. Where I live, Ontario, it can take up to a year just to get a hearing. And then they haven't paid you maybe for 5, 6, 10 months. They're not out the door that day. It's months after that where they're actually out because the only one who can physically pick them up and throw them out is the sheriff. Not even the police can do it. It's not the way our system's set up. So if you have the so-called professional tenant, they'll pay you first and last month's rent, and that'll be the last dollar you get out of them.
And they stay for a
They can
year. And
stay for a year plus. I was on a phone call with somebody from Texas. I believe it was a real estate agent, and she was apologizing for the fact it took 3 weeks. You had to wait 3 weeks to evict a tenant that didn't pay you. And we're thinking, that is not a problem to wait 3 weeks. We could wait over
yeah,
a
in
year.
Texas they're pretty brutal. I've heard that as well in Texas. It's pretty brutal
Yeah,
when it comes to
so it's a landlord friendly state, and that's what you want, and that's why Texas is very popular.
Florida as well, right?
Florida as well. A lot of the southern states are popular simply because of demographics, population growth. A lot of people, as they get older, they tend to leave the Northeast and go south,
Mm-hmm.
or the Pacific Northwest and go south because it's warmer and drier. And you want a place where there's good growth. So places like the Carolinas, Georgia, Florida, very popular on for people in the east, and then the west, Arizona, Nevada. Those are some very popular states as well.
What about specific segments when it comes to tax benefits? Would you suggest single family, or you suggest multifamily? What's the best segment of real estate to get the max tax benefits?
The tax benefits are much the same. It's just a question of scale for the most part, right? And a lot of people start off with single family or perhaps a duplex because that's what they're comfortable with. And that's fine. Yeah, you're going to make some mistakes. And You want to make your mistakes when the stakes are not as large. But after you do a
Mhm.
few deals, you'll realize that doing a 10 unit apartment building deal, it's not 10 times the work of a single family,
Mhm.
but the income can be 10 times as much.
Do you need reliable shipping across Latin America and the Caribbean? CaribbeanShipper.com specializes in delivering from the U.S. straight to your door in Colombia, Panama, and Argentina. And yes, they also serve the Caribbean, from Turks and Caicos all the way down to Trinidad. Right now, they're rapidly expanding in Medellin, Colombia, and quickly growing their presence in Panama and Argentina. With door to door tracking, insured shipments, and seamless customs handling, they've got your shipping needs covered. So, whether you're a digital nomad, a retiree, or a business scaling internationally, Caribbean Shipper is your trusted partner. From consolidating online orders to shipping full container loads, they ensure your packages arrive safely. So register today at CaribbeanShipper.com/register and let them take care of your shipping needs throughout Latin America and the Caribbean. The thing I like about multifamily is, like you said, if you have 10 units and one guy leaves or one guy screws you around somehow, you're not super stressed about getting someone else back in there, right? Whereas with a single family, someone leaves, you're like, oh God, how do I get somebody else in here?
As a CPA, we like to go right to the numbers. And your example with the multi-unit, 10 units, one unit is not paying rent, you have 90% of your income.
Mm-hmm.
Single family, one unit's not paying your rent,
You
you
got
have
zero.
0% income. So,
Exactly.
so that's,
Exactly.
I think that's a good spot to look at once you have some comfort with the whole industry. And the big boys, anything, 5 to 20 units, it's way too small for them to even look at. You start getting too large, you know, we're talking the hundreds of units, you're going to start bumping into some larger players, and they're often able to outmaneuver you because this is what they do all the time, and they have the
Mm-hmm.
processes down so that they can move very quickly. So for more of the retail investor that I tend to work with, 5 to 20 units seems to be the sweet spot.
Another thing that I noticed just in talking to friends or people on a daily basis is most people don't even consider the tax implications or the tax benefits of owning real estate. They'll just look at it like, well, I got it for 10% below market price, and I'm going to get this much in rent, and blah blah blah. They do basic numbers, but you never hear them say, well, after I figure in depreciation and all the write-offs, would you agree with that? That the novice investor very rarely looks into those details.
Depreciation is a unique concept because it's a non-cash expense. I think people realize pretty quickly I'm going to have to pay property taxes. I may
Mm-hmm.
have HOA or condo fees. I'm certainly going to have some repairs. I'm going to have interest if there's any loan involved. And those are all indeed cash expenses, but depreciation is not. And so I think you're right. A lot of them miss it. And it's
It's a huge savings. I mean, right?
it's a huge thing. And when you're able to have a cash flow positive situation and at the same time pay no taxes on that, that can be a great thing because it's literally tax-free income.
It's 27 and a half years in the U.S., right?
27 and a half, yes, for residential units. That's the basic number.
And that's only on the house itself. It's not on the land you can't depreciate.
Correct. Yeah, and you have to have an allocation of the purchase price between land and building, and that's something that people who know about depreciation often miss. They're effectively trying to depreciate the entire purchase price, and that's not
Mm-hmm.
possible. Even
You can split those though, right? When
that's
you
right. You split them out when you start, but even with a condominium apartment, there is a portion of that purchase price allocated to land. The common elements, what they're called.
is there a percentage that's just kind of uniform, or?
There is in my practice. I've seen all the examples in the government website say, well, you just allocate between land and building according to the price established in your agreement of purchase and sale. Sounds straightforward, except in 30 plus years, I've never once seen an allocation between land and building in the purchase agreement. So
Hmm.
I just have a rule of thumb, and so far, it's never been challenged, which is if it's a single family unit with typical, half acre or whatever, it's going to be 20% to the land and 80% to the home. And in a condo, it's going to be 5% to the land and 95% to the home.
So you get depreciation on 95% of.
Yes, in the condo situation, that's right.
Here's my question: in the cross-border investments, and it may work different, U.S. and Canada versus like U.S. and somewhere else, because I know the U.S. and Canada sometimes have different agreements. But if I'm in the U.S. and I'm investing in Canada, can my do the same laws apply? Can I still get depreciation on my U.S. return for my Canadian property?
Yes, there's only one difference that I'm aware of, and it is exactly on that depreciation. And the difference is in Canada, it's optional, and in the US, it's required. So in Canada,
So you have to depreciate in the
you
U.S.
have to depreciate in the US. In Canada, you can take anywhere from zero all the way up to your maximum allotment.
Why do they make that an option? Or I guess maybe the better question is, why would the U.S. make it a requirement? Because they're losing out on that, right? If you
That I can't speak to the policy reason on the US side. I know on the Canadian side, if you're in a growth market like I am here in Toronto, if you sell your property for more than you purchased it for, which is obviously the goal on investment property, you will have to pay tax on all the amount that you've depreciated over the entire time you've held the property. So while you do get a deduction while you own it, that all comes back on you when you sell it. And that's definitely going to push you into the top tax bracket. With
but in the U.S. that's not the case.
in the US, there is recapture as well, but you don't have a choice. It's literally a requirement that you depreciate it. And so what I do for people that own in the high growth areas like Toronto, and the plan is to sell it relatively soon, say in the next 5 years, we typically don't take depreciation because we know it's all going to come back, and you get the deduction at a lower tax bracket, but you get the income inclusion at the highest tax bracket. So ignoring the time value of money where dollars 5 years in the future cost less than dollars today, you will actually be out of pocket on that.
What about? I mean, you may or may not know this, but if you're in the U.S. and you invested in property in Brazil, as an example, is it still the same where you bought a property, so you're still going to depreciate that on your U.S. tax return, or what other country? I would imagine it's just a
I, I
uniform
can't
rule,
I
right?
can't say for sure, but the basic rule is when you own property in another country, you have to deal with it on your domestic tax return as if it was a domestic property. In other words,
Great,
you have to use the same rules.
good. So you still get that depreciation. That's good.
You would if that's required, and it is, as we established, it is required in the US. And that's simply because otherwise your return would be a mix of things. So let's say you had some property in Brazil, Colombia, Venezuela, and they all have different rules. And you also have property in the US. Well, you have four different types of real estate income in effect on your tax return, but there's no ability to distinguish it, right? Everything has to fit into the US forms at the end of the day
Mm-hmm.
because, we're assuming everything's owned individually at this point. That
So you would just file your tax returns as normal if you own international real estate.
you'd be filing it the same way as if the property was in your home country. I think that
Wow.
that's safe to say. And I know that applies for Canadians who invest in the US, that they can't follow the US depreciation rules when calculating income for Canada purposes. Now, when you're filing the US tax return, you'd obviously have to file the US rules.
Here's what another thing I find interesting. I've dealt with international real estate for quite a while, helped a lot of buddies out. And one thing that I noticed is that the US doesn't require you to report your international real estate purchases, which is weird. But then if you go file taxes on that, that is reporting it, right? And then also, if you send, let's say, $200,000 to an international country, most of them won't allow you mortgages. So you're paying that in cash, and you're going to have to report a $200,000 transfer. So it's like, okay, I sent $200,000 to Brazil. Well, why'd you send that? Well, at some point, you have to tell them why you sent $200,000 out of the country. Otherwise, they think you're a drug dealer. So,
It's getting worse than that, right? You try sending money domestically. Now, you take your
mhm.
money out of your account and send it wherever. Now you have to explain why you're sending that money. Uh,
Yeah. So do you know why they like? It's kind of contradictory. I don't know why you
don't
would say you
necessarily,
don't have to report your international real estate, but
you don't necessarily have to report your purchases, but you do have to report the income. That's for sure. And I know the Canadian rule is if you own property outside the country costing $100,000 or more, you have to report that, even if there's no income on it. It's just a reporting. So I don't know if the US has that same rule. I do know as soon as you start moving money back and forth, there's going to be
mm,
reporting.
absolutely anything over 10 grand, I think it is, you have to report internationally, right?
Anything over 10 grand, the bank will report to the government for you. But there are also disclosures when you move money. So if you, as an example, if you have a US company and a Canadian company and you move money by paying a bill, right,
Mm.
from US to Canada, you have to file a special form to report that. There's not necessarily any taxes involved, just moving that payment. And if you don't, it's a $10,000 fine if you're late by a day.
Wow.
Ask me how I know that.
That same guy that had 3 years of no tax returns,
No, no.
no, different
I
guy.
personally got a love letter from the IRS saying,
Oh,
yeah, we know you filed the tax return, but you didn't file this other form, so $10,000, please.
oof.
And just like my clients, I have my own US taxes filed by my American CPA colleagues. So a couple of frantic days later, I got a hold of them and said, I know we filed an extension to file the corporate tax return, and we filed it well before the extended deadline. Oh, yes, that's right. Just curious, no particular reason. Did you happen to file this other form with that tax return? Oh, yes, that's a very important form to file. It's part of it. Okay, well, I got this letter from the IRS saying they didn't get the form and they want 10 grand. What's going on? Oh, they just don't know they have it. So what happens? Well, a lot of people just pay the bill.
Oh,
So what do we do? Well, answer all their questions. So I answered all their questions, sent it in to the IRS, got another letter back. You think they'd say, we've looked at your information, it's good, or we need more? No. It says, uh, paraphrasing, we know you sent us something, but rather than look at it, we're sending you this letter saying we need 45 more days to look at it.
so just wait the 5 more days, look into it, and
Oh,
then send
yeah,
me the final result.
45 more days, we'll look at it. And then get another letter from the IRS. Yeah, you know that 10 grand you owe us? You owe us now the interest on that 10 grand.
Ugh.
Then I get a third letter from the IRS saying 10 grand plus interest, previous balance, adjustment, updated balance, zero. So they had the form that they asked for all along, but because it's a left-hand, right-hand thing, they just fire off these letters automatically as soon as they see a related party transfer out of the country.
Mm-hmm.
10 grand for not filing the form on time. Canada has a similar form, but only if you send over $1 million out of the country do they care about this form. In the US, if you send $5 to a related party, foreign entity, and you're a day late, it's 10 grand.
The IRS just has too many employees, man, with nothing to do, and
Yeah.
they just firing off letters for no reason.
Yeah. And a lot of this is just the computers, right? Right. The computers say,
Mm-hmm.
oh, related party payment, send out this letter. Because what's that cost them? Next to nothing. And they get one
Mm-hmm.
person to pay that when they shouldn't have. How they're so far ahead.
Yeah. Mm-hmm.
And I know a lot of people getting that letter from the IRS, they're too scared to even open it.
Yeah, they don't even want to call. They just write a check and it's over.
Yeah.
Yeah,
So
absolutely.
that's why I started doing what I'm doing, which is working with the cross border and the real estate investors,
Yeah.
because I take that off their plate and they can just go out and do real estate.
What about the structure? I know you talk a lot about creating the right structure behind your investments. I assume you're meaning like each individual purchase would be in like an LLC, and then you have a holding company over that, something like that.
Yeah, that's much of it, right? Because if you're going to do anything other than wholesaling, which is you never really take title to the property, you actually you, you buy the right to buy the property, and then you sell that right to someone else for a markup, and you pocket the difference. So it's pretty safe to do without setting up an entity. But anything beyond that, if you're flipping houses, if you're doing long-term rentals, that all needs to be done through an entity. And what I recommend typically with my Canadian clients are they set up a corporation in Canada, which then will set up a Wyoming C corporation, and that C corporation will then be the sole owner, or what they're actually called members in LLCs, sole member in the state that they're investing in. So Florida, let's say. And that allows Canadians to take advantage of the flow through or disregarded entity aspect of how almost all LLCs are treated without it being a problem. If a Canadian owned an LLC directly without the intervening corporations, they'll end up getting double taxed because it's a mismatch of it works very well for Americans to own LLCs directly because the income and expenses from the LLC flow through to their US personal tax return, and that's the end of it.
Yeah, in the U.S., I think the recommendation is that each entity, each property you own, has its own LLC, and then you have one major holding company that houses all that. It sounds like a fairly similar setup in Canada, except you use C corps versus the LLC.
Yeah, well, the C Corp is effectively the holding corp because you could have
Mm.
10 LLCs in 10 different states, each with 3 properties in them, and all the income expenses from those 30 properties will flow up to one C corporation in Wyoming, and that would be the only one that would file taxes. None of the LLCs ever file taxes in that scenario.
And you're setting it up under that corporate structure for several different reasons. One of those being legal, right? And then so they can't come after you if there's any judgment. They can't come
That's
after
right.
you for
That's right.
and and then secondly, those LLCs have more flexibility with taxes, right? With the U.S. government, they have more flexibility. Like you can change the way you
Yeah.
file.
Yeah, you can change it. It is more flexible and it's a little cheaper as well. And the main reason though is to have that flow through ability because in the scenario we talked about, the Wyoming C Corporation is doing no business directly. So there's no ability to sue it because it has no assets other than it controls these LLCs. And if there is an incident at one of your properties, it's confined to that LLC that owns it.
Yeah, they can't mess with the rest of your portfolio because they all have their own separate entities.
That's it. So it's for asset protection purposes as well as to simplify the filing, because otherwise, if you had 10 LLCs, you'd have to, and you weren't flowing them through, you'd have to file 10 different tax returns.
Mm-hmm. So you would just file one tax return in that scenario under the C Corp, and that's it?
You'd file one federal tax return and then one state tax return for every state you're invested in. So if all your investments are in one state, you'd file 2 tax returns. You could have, 10, 20, 30 properties.
Wow. What, besides what we've talked about already, what would you see as some of the most overlooked tax implications in real estate? We probably covered most of them, but
I would say that something that people don't immediately connect to is the ability to leverage your investments, because typically you're putting down maybe 30% and you're getting financing, whether it's from private investors or a bank, for the balance. And many other types of investment, you have to come up with 100%. Cryptocurrency, stocks. I mean, you can trade on margin, but that's very dangerous, because if the market moves against you, you start getting capital calls from your broker.
margin called.
Yeah. The dreaded margin call, and you can quickly wipe out your entire holding and go negative, right? Just one politician says one wrong thing against the industry that you're invested in, and you could be getting a call from your broker the next day. So.
Yep, exactly. Perfect. Any social media or anything?
That's the best way to get. I'm on LinkedIn. You can find me there as well.
Okay, perfect. Well, thanks, Michael. I think this was extremely valuable information. Appreciate you coming on.
Thanks for having me.
Thank you for joining us on the Matt Chambers Show. I'm your host, Matt Chambers. I hope you enjoyed today's episode. Don't forget to subscribe, rate, and review the show to help others discover it. Until next time, keep traveling, keep doing business, and keep living beyond borders. See you soon.